On the surface, FTX looked like a brilliant crypto exchange. It was a customer fund siphon run through Nassau by Sam Bankman-Fried in 2022. With old fraud habits wearing new software. The technology was modern, the conduct belonged in a museum. Bankman-Fried played the prodigy role expertly. Jane Street alumnus, quantitative polish, t-shirt informality, and a cultivated air of moral arithmetic. Gary Wang built the code. Nishad Singh handled engineering. Caroline Ellison ran Alameda Research, the trading firm standing far too close to the exchange. The surrounding cast mattered. Sequoia, SoftBank, Temasek, Ontario Teachers, and a list of respected venture names sat around the cap table. U.S. regulators circled the business without pinning it down. In the Bahamas, FTX had friendlier weather, lighter oversight, and the usual island illusion of distance from consequence. The setup began with a bull market and a regulatory fog bank. Bitcoin wealth produced a rush of deposits. Exchanges collected fees, minted house tokens, and called it infrastructure. Venture investors paid growth multiples for speed. Few insisted on the dull items: segregation, treasury controls, audited governance, board minutes. There was also a prior deal hidden in plain sight. Alameda had been the internal market maker from the beginning. That arrangement can work with brutal controls and bright lines. FTX had neither. The exchange, the token issuer, and the trading shop lived in adjoining rooms, passing risk around like a dinner bill. By 2021, the valuation story had become self-reinforcing. FTX raised at roughly $18 billion in July, then $25 billion in October, and $32 billion by January 2022. The market saw operating leverage and network effects. The room should have seen a governance discount large enough to drive a truck through. The mechanics were primitive. Customers deposited dollars and crypto on FTX. Alameda received special treatment inside the system, including what later appeared to be exemption from ordinary liquidation rules. That is the hidden liability. Once one favorite account can run negative without consequence, the exchange stops being an exchange. Then came the internal financing loop. Alameda borrowed against FTT, the token closely tied to FTX itself, along with other illiquid crypto collateral. In conventional finance, that is akin to borrowing against a market value partly manufactured by the borrower and its affiliates. Cheap until Tuesday, fatal by Friday. The paperwork was thin where it needed steel. John J. Ray III later said he had never seen such a complete failure of corporate controls. No proper board oversight, weak accounting systems, expense approvals through chat messages, corporate cash used for Bahamian real estate. The price was never the deal. One figure captures the entire machine. Prosecutors said roughly $8 billion in customer money went missing into Alameda's hole. The exact trail had moving parts, but the economic fact was plain enough. Deposits treated as an internal funding source. Old misconduct, new wrapper, very efficient user interface. The friction started in the open. On November 2, 2022, CoinDesk reported a balance sheet showing Alameda heavily reliant on FTT. That was the first crack visible to the public. Inside any serious boardroom, alarms would have gone off instantly. Concentrated collateral, related party exposure, circular valuation, pick any term. Then Binance entered the frame on November 6th. Changpeng Zhao said Binance would sell its FTT holdings. That short message did what no regulator had managed. It triggered a real-time confidence test. Customers began pulling billions. Exchanges are confidence businesses. Lose that, and code merely counts the exits. The late-night rescue theater followed. Binance signed a non-binding letter of intent on November 8th, then walked within a day after due diligence and reports of mishandled customer funds. I have sat through versions of that call. The buyer asks one question twice. Silence answers it. The result was immediate. FTX, Alameda, and dozens of affiliates filed for Chapter 11 on November 11, 2022. Bankman-Fried resigned as chief executive. The new management found missing records, unsecured digital assets, and governance habits more suited to a student club than a financial institution handling global deposits. Monday morning brought the usual pieties and a more durable fact. Crypto prices fell. Lenders froze, counterparties marked down exposures, and politicians discovered concern. Customers discovered hierarchy. In any insolvency, the slogan disappears and the waterfall remains. Marketing copy has never ranked ahead of secured claims. Then came the legal reckoning. Federal prosecutors charged fraud, conspiracy, and campaign finance offenses. Bankman-Fried received a 25-year sentence. Civil cases and bankruptcy recovery actions continued around the estate. The press treated the conviction as closure. Boards know better. Collapse is only the first invoice. I have seen the pattern before. Enron in 2001 used related entities, marked values that management preferred, and a board that missed the economic substance behind formal structure. Different asset class, same instinct. Keep confidence alive, move risk off stage, and hope the audience applauds before the cash runs out. A second analog is MF Global in 2011 under John Corzine. There, the technology was ordinary, and the leverage was old-fashioned sovereign debt. The failure mode rhymed perfectly. Customer funds and firm risk drifted too close together. Once liquidity tightened, legal nuance mattered less than the hole in the account. 30 years in the room taught me one narrow lesson about operations dressed up as platforms. When management insists the system is sophisticated, I look for the reconciliations, the cash controls, and the authority matrix. Adults write things down. Frauds prefer charisma, velocity, and a forgiving cap table. I have seen this before. Here's what it means. FTX was not a crypto mystery. It was an ancient related party raid, accelerated by software, and blessed by prestige. Which board would have caught this earlier? Be specific.